SoFi Technologies Inc. is currently trading at exactly $26.47 per share, experiencing a downward intraday movement of 57 cents, which translates to a decline of roughly 2.11% for the session. The market is open, and the volatility we are witnessing right now is substantial, pushing the stock slightly lower from its opening price as traders react to the immediate technical resistance levels formed over the last 48 hours. What you are seeing on your screen is not just a red day. It is a calculated retraction following an unprecedented run that has left many analysts scrambling to update their models. Most investors look at this 2% drop and see weakness, expecting that the massive rally of 2025 is finally running out of steam. They see a stock that has doubled year to date and assume the gravity of valuation is finally taking hold, pulling the price back down to historical norms. That is the expectation, that the party is over and the smart money is cashing out. The reality, however, is far more nuanced and potentially explosive. This pullback to the $26 range represents a classic consolidation phase within a much larger, aggressive upward channel that has been building since the company effectively demonstrated scalable profitability in the third quarter. While the general sentiment fears a reversal, the deeper order flow suggests that institutional investors are using this specific dip to reaccumulate shares before the next leg up, driven by the just-announced reintegration of cryptocurrency trading and the expansion of the Galileo platform. You are not looking at a sell-off, you are looking at a liquidity trap, where retail investors are being shaken out right before the company pivots into its next growth phase. We need to look closely at the tape, because the volume today is telling a story that the headline percentage change is trying to hide. The price action we are tracking today, hovering just above the $26.40 support line, is critical. If you have been following Tesla stock or Nvidia stock in their early breakout phases, you will recognize this pattern immediately. High volatility on lower relative volume during a consolidation. It signals that the sellers are exhausted, even if the price is red. The expectation was that SoFi would struggle to maintain momentum after hitting the $32 high earlier this year, but the reality is that the floor has been raised significantly. We are seeing a battle between short-term profit takers who entered around the $14 mark earlier in the year and long-term accumulators who see the path to $40 as inevitable. The market is trying to digest the recent news that SoFi is officially back in the crypto game, allowing members to trade Bitcoin and Ethereum again, a move that directly challenges Robinhood stock trading and Coinbase. This isn't just about offering a service, it is about reclaiming a high-margin revenue stream that was paused, and the market is underestimating the impact this will have on the fourth quarter earnings. When you compare this movement to the broader sector, the divergence is clear. While traditional banks are trading flat, SoFi is moving with the beta of a tech company. The narrative that this is just a bank has been shattered. The expectation was that high interest rates would crush their lending margins. The reality is that their net interest margin has expanded because their cost of funding is significantly lower than their competitors, thanks to the massive influx of direct deposits. You are looking at a company that is effectively growing its deposit base, while Fidelity Investments and Charles Schwab are fighting to keep cash from moving into higher-yield treasuries. SoFi is winning the war for the primary checking account, and that stickiness is what justifies the premium valuation we are debating today. The 2% drop you see right now is arguably the noise. The signal is the sustained hold above the 50-day moving average. Let's talk about what is actually driving the volume today. We are seeing a rotation out of pure defensives and into growth at a reasonable price, or GARP strategies. SoFi fits this perfectly. It is no longer the speculative cash-burning SPAC it was years ago. The recent Q3 earnings report, delivering $950 million in revenue, up 38% year over year, was a wake-up call. The expectation was that growth would decelerate to the 20% range. The reality was a massive acceleration, driven not just by lending, but by the technology platform. This creates a tension in the stock price. Value investors think it's too expensive at $26, while growth investors think it's cheap relative to its future cash flows. This friction is what causes the volatility we are seeing today. Every time the stock dips below $26.50, buy orders trigger, likely from algorithmic trading desks that recognize the disparity between the price and the intrinsic value of the user growth. Speaking of user growth, this is where the comparison to Robinhood app and SoFi Invest becomes crucial. The market expected SoFi Invest to remain a secondary feature, a nice-to-have add-on for people who took out loans. The reality is that the active investing platform has become a primary driver of daily active users. They are not just capturing the loan, they are capturing the wealth accumulation lifecycle. When a user switches their direct deposit to SoFi to get the higher yield, they inevitably start using the self-investing tools. It's a flywheel that Schwab Intelligent Portfolios has tried to replicate but struggles to match in terms of user interface and demographic appeal. The friction for a user to move money from a SoFi checking account to a SoFi stocks account is zero. That velocity of money is what you are paying for when you buy the stock at these levels. You are buying the ecosystem, not just the bank charter. I want you to take a second and look at your own portfolio. Comment below how many shares of SoFi you currently hold and what your average buy-in price is. Are you green or are you weathering the volatility? It is interesting to see how many retail investors held through the single digits to see this recovery. Now, let's analyze the technology stack, specifically Galileo and Technisys. This is the part of the business that the market consistently misprices. The expectation is that SoFi is a consumer-facing brand. The reality is that it is the AWS of fintech. Through Galileo, SoFi powers the infrastructure for many of its own competitors. When you look at Interactive Brokers stock trading or other neobanks, many of them rely on the kind of back-end infrastructure that SoFi dominates. The drop today might be linked to skepticism about the tech platform's margins, but recent reports show that the tech segment is becoming profitable on a standalone basis. This changes the valuation multiple entirely. If SoFi's bank, it should trade at 2 times book value. If it's a fintech infrastructure company, it should trade at 10 times sales. The market is currently pricing it somewhere in between, and that confusion is your opportunity. We also need to address the institutional ownership changes we have seen recently. Data from September 2025 showed a slight decrease in total institutional ownership, which some retail investors interpreted as a bearish signal. However, if you look closer, the smart money that left were largely passive index funds rebalancing, while active managers actually increased their stakes. Fidelity mutual funds and other large active managers have been net buyers in the dips. They understand that the Robinhood crypto relaunch by SoFi is a direct attack on the fee structures of standalone exchanges. By integrating crypto trading directly into a banking app, SoFi removes the need for users to transfer funds out to a separate exchange. It captures the spread and keeps the liquidity within the ecosystem. This is the super app thesis finally coming to fruition, and the market is only just beginning to price it in.